Hello friends, today we are going to talk about a very important aspect of investment planning, which is asset allocation. Normally, whenever we see portfolios of clients and investors, they are either 100% in equity or 100% only in fixed deposits or bonds, or they must be having only gold and fixed deposits. There is a very important need to divide the assets into different asset classes so that the return of the portfolio goes up as well as the volatility in the portfolio is very low. To give you an example, if you have 50% in equity and 50% in fixed income or FDs, you will get half the return of equity and half the return of fixed deposit. So if long-term equity gives a return of 14 to 15% and FD gives you a return of 7 to 9%, then a portfolio of 50-50 debt and equity should give you a return of 50% of 14, that is 7%, plus 7% of debt, which is 33.5%. That is 10.5% should be your portfolio return on a mix of 50% equity and 50% debt. As you increase the equity allocation in the portfolio, return goes up from 10 to 11, 12, 13, 14, depending on what is the percentage of equity in the portfolio. Now, why this is important is because in the equity stock market, when the market goes up or when the market comes down, your return is derived from how much money you had in equity at that point of time and how much debt do you have in a portfolio when the market is absolutely in a crash situation or in a down situation. So all the people in 2009 when the market crashed were suffering because they had 100% invested in equity and the whole portfolio was down 30, 40, 50%. While the people who had cash of at least 20, 30% in the portfolio could take advantage of the situation and buy more equity and average out at the because that was the best time in hindsight to buy. So we, to all our clients, recommend that you should have at any point of time 20% in fixed income instruments so that you can take advantage of a situation of a recession or a depression in the economy. This helps because when the market goes down, you are the only one who is buying because you have cash of 20% in the portfolio and where everybody is selling. And the other way around, when the market is at a new high and your portfolio has become 80, 90% equity, that is a time to sell and correct that asset allocation to 80-20 again. If you just do this and just maintain a tight asset allocation of 80-20 or 70-30 depending on your risk appetite, then your return will be much about 13-16% compounded annually over a long period of time. So in summary, do not put all eggs in one basket. Divide the money into equity and debt, debt being the most important because you should have one part of the portfolio in a zero volatility, safe instrument to take advantage of the volatility in the equity market. Happy investing. Thank you.